The following informal two-part podcast was recorded this past Saturday, April 11, 2020. It's a two-part podcast response to some recent Macro Voice podcasts, as well a tweet storm of precious metal insults hurled by that podcast's host, Eric Townsend. The three individuals on this call you're about to hear have been working in various facets throughout the precious metals industry for over 4 decades combined. At the start, the first part, you're going to hear Roy Sebag, the CEO of Gold Money, give an explanation and nuanced update regarding the mechanics of this historic and ongoing price divergence between London and the COMEX gold futures market. On this call as well is Ned Naylor-LeyLand, an investment portfolio manager for the Marion Gold and Silver Fund, and myself, James Anderson with SDBullion.com. Okay, let's proceed with our two-part response. So, Roy, what we're going to start with is simply getting your context and your take on what's going on in the precious metals markets, because I mean, as far as someone who's straight up in the game right now, you have probably more a better understanding of what's going on in terms of the bullion supply-demand situation. So, could you give us just your insight as to what's going on there?
Sure. So, thanks for having me on this show. I've been in the precious metal industry now for about 6 years in my capacity at Gold Money. And so, as you mentioned, we're deeply involved in the physical market. We are trading, buying, selling physical metals across multiple vaults around the world every single day. We also engage in every kind of trade you can think of in our dealing desk when it comes to hedging. We deal with most of the counterparties that are LBMA members and most of the counterparties that are CME and COMEX clearing firms or dealers. And so over the last few weeks, we have noticed that a few aspects of the gold market have broken down, and we've tried to communicate this information to our clients and to the greater market because we felt that information wasn't making its way to the market. In fact, still today, I think there's a lot of confusion in terms of exactly what's going on and what's causing the disruptions and how bad they are. So I'm happy to provide that information to you. Do you have any specific questions about the market? Because it's
yeah, certainly. So of late, there's been coverage I've done on my behalf for listeners that are listening to the content that I produce. There's been a huge divergence, obviously, between the COMEX futures price and the London over-the-counter spot price, essentially, and that hasn't really happened, but one other time in the last 50 years in terms of the percentage of the underlying basis. I think in the late 70s, early 80s, there was a pretty big divergence that occurred, but that was during the mania phase of the last Western-driven gold bullion bull market, and so for it to be happening right now is kind of strange. So I just further insight as to what you're seeing and perhaps why that divergence is occurring.
Okay. So I think a lot of people actually don't know exactly how COMEX and LBMA work. So perhaps I'll give a very brief primer and that'll help us understand where the issues are.
Yeah.
So most of the gold market in the world is based on the London Bullion Market Association spot price, which is a pool, an association that came about at the end of the London Gold Pool. When the London Gold Pool broke, this became sort of the replacement for that. Now, what the LBMA market is, it's a collection of clearing members, trading banks, bullion banks that set the price for gold, which is an unallocated price for gold in London at specific London vaults. Now, when the LBMA, for example, says we have this much metal in our vaults, what they're saying is they have this much unallocated metal, and they also include the Bank of England's metal. So if you look at the latest numbers from LBMA, they say we have 267 million ounces. Well, 180 million of those ounces are actually at the Bank of England, and then the other amount is at LBMA member vaults. But all of that gold is considered unallocated spot. Now, technically, if you're a member of the LBMA and you have a relationship with a counterparty that is transacting under LBMA rules, you can purchase LBMA spot and you can convert that unallocated position to allocated within T plus 5. Those are the rules. You have to, the counterparty has to deliver metal to you within T plus 5. Now, ordinarily, that is actually settled a lot sooner, like 2 days, 3 days, sometimes even the same day. But what that means is that you're taking metal out of the LBMA unallocated pool and into a vault in London that's near those vaults. And that whole market, as things stand, is working just fine for the existing counterparties. So you're buying LBMA spot, it's unallocated, you decide to allocate it, the counterparty has to deliver the metal to you, and we've conducted trades like that all the time. The problem is getting the metal from unallocated to allocated in London, and then moving the metal anywhere other than London, say to Switzerland or to Hong Kong or to Dubai or to Singapore, that has become effectively impossible. Now, the reason for that is the COVID supply disruptions, both in transportation, but also to the actual refineries. So that's the LBMA unallocated market. Now, in parallel to that, you've got the COMEX futures market, which is traded around this one contract, which is called the GC contract. And that's a futures contract that ostensibly gives its owner physical delivery. But the process for going from buying that future to getting the physical delivery, contrary to what most people know or understand, is not such an easy process. So I'll walk you through how it works. But to begin with, there's a very important point to know about the GC contract. The GC contract allows the counterparty that's on the hook for delivery to deliver you a 100-ounce bar or an LBMA bar that is within 5% plus or minus if it's a 100-ounce bar, or 7.5 to 12.5% plus or minus if it's an LBMA bar in weight. So there can be a discrepancy from the price that you're paying to what you're getting in weight at settlement. Now, that discrepancy has to be made whole by the counterparty, but the counterparty is allowed to make that discrepancy whole in unallocated metal or in cash. And so this is a very important distinction just to start to understand how the futures work. Even if you purchase the futures and you ultimately go through all the cycles of getting delivery, you could always get 5 to 10% less than what you paid for, not such that you lose money, but such that the physical weight you get is less and you're compensated with some kind of an unallocated or a cash payment. Now, if you buy that contract, and they usually trade in the front 2 months, so right now you'll have the April and the June contract, which have most of the open interest. It's not as though you just buy that contract and you say, I want delivery now. There are only specific days of the month approaching the end of the contract where you're allowed to stand for delivery. And so while the contract is being traded and there's buyers and sellers, a lot of that buying interest is speculative and a lot of that selling interest is speculative. So for example, most people that have access to a futures account and can buy the GC contract, they can't even take delivery or issue a notice to stand for delivery because their brokerage firm will close them out as the contract approaches expiry. So this is a very important point. So if you have an Interactive Brokers account and you buy the GC, you can't just say, okay, I want the physical. Interactive Brokers will close you out before the contract expires. But there are certain clearing firms that will allow you to buy the futures contract and work through the entire clearing process. Now, if you're going to do that, it's a process that at best, for the contract that is being traded right now, at best, is a 2 to 3 week process, where essentially you go from standing for delivery, being allocated what's known as a warrant for actual metal, a specific bar of metal, what the COMEX calls registered metal, and then loading out the metal, taking the metal out of the vault. So that process is always 2 to 3 weeks. But when you look at the open interest right now, there's very little open interest in April, whereas there's a lot of open interest in June. And so most of the metal that is being purchased right now in June can't be physically delivered, even if everyone stood for delivery until the end of June, early August at best. Now, this is for New York metal. Now, for multiple reasons that we don't have to get into, the way the COMEX market developed was that bullion banks would essentially be naturally short the COMEX and naturally long the LBMA spot price, the unallocated metal that we talked about earlier. And so between London and between New York, there can develop a spread. And that spread has a technical term called the EFP, the exchange for physical. And what happened over the last few weeks was that as the previous contract was getting close to expiry, all of a sudden, a lot of counterparties on the COMEX side realized that they couldn't take the metal out of London from unallocated to allocated, ship it over to New York, and settle their shorts. And so they had to go into the market and cover a tremendous amount of the short contracts they had opened. In fact, multiple banks' bullion desks blew up because of it. Now, when they did that, that EFP indicator that I mentioned went from essentially about a few dollars, which is what it normally is, to $95 bid and no ask. There was no way to actually get this trade done. And we were in a position to sell some metal in New York at that time at that $100 an ounce premium, and we did that. Now, the EFP today, even today, so as of Thursday close, is $55. So there's a $55 premium over the LBMA spot price. But interestingly, there's also a very large premium right now between the April GC contract and the June contract. So if you can just buy an April GC contract, stand for delivery, and sell the June, you can generate a 3% return, absolute return, in basically 60 days, 60 to 90 days, risk-free. And so these kinds of spreads shouldn't exist, as you mentioned. And that gets into, why do they exist? What's really happening? And what does this say for the price of gold? Because there's been a few commentators who primarily trade in the futures, who I don't genuinely believe have ever taken physical delivery the way that we do. And they believe that the futures price somehow reflects that this purely has to do with a supply shock as a result of COVID. But the physical markets are sensing something completely different. And I think the price action of gold, ultimately, all the things that I mentioned, they can only suppress the price of gold, because eventually the physical gets settled, the physical gets cleared. And the only way that this whole system between the LBMA and the COMEX can continue functioning is if somewhere in that unallocated pool in London, some entity, which is likely a central bank, is leasing metal into that pool over and over. But as long as people keep moving metal from unallocated to allocated in London, then the market's clear. And that's why you see the price of gold behaving the way it does. It ultimately reflects completely other things, the debasement of money. But what we're seeing now between the COMEX, the LBMA, the COMEX front month in the June, and the ability to buy LBMA and ship it out of London, I think has more to do with another dynamic in the gold market than just the technical issues with COVID. It's kind of like the way some of us believe that COVID was the pin that popped the bubble in the economy. We feel the same way about what we're seeing in the gold market. These supply disruptions are the pin that are unveiling a much greater issue with the futures market and, most importantly, the LBMA spot market.
Right. Thank you for that. That was very enlightening and well spoken. Ned Naylor-LeyLand, I know that now 10 years ago or something, you were really focused in on what Roy just talked about, but now you're more into the mining shares and such for your fund. I want to get your take of what Roy just said and then what you're seeing in the markets.
Sure. So, look, I mean, Roy's at the coalface with this, and you're quite right to say that it's something that people have identified as likely to show up at some point because of the nature of the way the gold market architecture is well, I would say taped together. What I'm seeing, I suppose, is oddly, I think in a way I spend more time looking at what you do, really in the retail end, and talking to institutional investors who want to understand whether or not there's a problem with sponsored synthetic sort of / physical products in their portfolios. And for a long time, I've said that the gold and silver mining stocks will receive enormous flow from big long only money. And one of the reasons it will happen is because physical will go no offer. I've always said that, and I think we're getting quite close to it. We're quite at that point, and Roy quite rightly identifies that so far in London, this trade is still alive. Although, I mean, for me, the the spot physical market, as some people call it, it's not quite that, is it? There's a bit more that goes on. It's a lot grayer than that. And really, for me, it's a bit of a roach motel until the physical is removed, as Roy says, quite rightly. Until the physical leaves, you're still involved in that overall dynamic. But I do feel that investors are becoming more interested. This narrative is starting to percolate further into the world of the non-gold bug, the non-gold investor as part of a sort of core allocation. And I think that can be important in terms of how the next steps, unravel.
Yeah, I was just thinking in terms of the LBMA float. I use a lot of charts from Nick Lard's goldchartsrs.com, and he has a chart that shows the float in the LBMA system is roughly 1,000 tons of gold, essentially. And that refers to every time the LBMA comes out and talks about, we have 8,000 tons of gold in our system. Well, it's already spoken for the vast majority of it. So the float, as per se, is simply the gold that possibly could become allocated, as Roy had mentioned. And then you look over at the COMEX, who's changing rules with the 4GC contract just in the last couple of weeks, which totally smells of panic. It smells of something's wrong. And even if you look at both their combined registered and their eligible gold fractional reserve backing, they have roughly just over 500 tons now that they've added all these 400-ounce gold bars, mostly from JP Morgan. So you're talking about a combined float of just over 1,500 tons. And in the physical world of gold, that's only 75 basis points of all the physical gold that's ever been mined. And those two conduits have control on the price mainly in the world. And so,
yeah, but let me just jump in there. I just want to clarify a few things. So
sure.
So the first thing is, under the LBMA rules, it's important that I stress this. The unallocated position has to be backed by allocated metal. So there has to be an actual weight of metal backing the unallocated position somewhere. That's a fact, and I believe it's true.
Okay.
The way that's done is going to get us into an interesting conversation, because if a central bank has metal at BOE, at Bank of England, and they lease that metal to JP Morgan, and it's considered unallocated, the central bank can still carry that metal on their balance sheet, or the BIS, for example, or the IMF. And JP Morgan now can go to the LBMA and say, well, I have an unallocated balance, which I can then use to sell to someone that's hedging a COMEX future. It's backed by physical. The physical is at the BOE. It's been sitting there the whole time. However, when the COMEX trader says, well, I need to collapse my short, and I need to convert that unallocated to allocated, at that point, we don't know if the central bank in their lease agreement will ever account for the fact that now that metal is no longer unallocated, but is actually left to the JP Morgan vault. And I think that if history is any guide, what's most likely been happening is that most of the central bank gold over the last 20 or 30 years has funneled through the Bank of England into these unallocated LBMA spot contracts and then has been slowly leaking out, so that a lot of the LBMA unallocated metal is still owed to a central bank, which is carrying it on its balance sheet. The central bank is the big loser in all of this.
Mm-hmm.
But at a certain rate, the central bank doesn't have any more metal to lend to this mechanism, and the physical keeps leaking out of the LBMA unallocated, then it's a physical market. The price has to clear and the price has to go higher. And I think that's part of the dynamic of what we're seeing. Now, all this stuff with the COVID in New York, where people can't get metal in New York, and that spread that's developing, think of that like an additional snowball that's compounding. And so we saw what happened last month's expiry. If things don't improve in the next 3 weeks, that compounding amount between COMEX and LBMA is going to cause a crazy rush again for covering. Just like we saw open interest collapse in COMEX last month, we're going to see a major collapse again this month. And as that's happening, more metal leaks out of unallocated LBMA into allocated. And so there's kind of like a perfect storm, because what's happening here has nothing to do with new gold demand based on fiscal stimulus, Federal Reserve action, central. That's just like the cherry. That's just like additional flow demand into gold. The issue that has developed because of these futures markets and the LBMA market is there's kind of like this natural short between the central banks, the BOE, the LBMA unallocated, and the GC open interest and the LBMA. And so that's causing these premiums to surge. And in the meantime, if you're involved in the precious metal industry where you need the end product, whether you're a mint, a refiner, a fabricator, a manufacturer of jewelry, you can't get any physical metal in New York right now or in the US. And if you buy the LBMA, I forgot to mention one thing. If you buy the LBMA unallocated and you say, well, I want the allocated, you also have to pay a massive premium. It could be as high as $30 above spot. And so there's this delay. There's this like 5-day delay on the LBMA. You can only get it in London. You can't ship the metal anywhere else. And then there's this 2 to 3 week delay minimum in the GC contracts. And all of that is like the kindling, which is a technical problem that has to be resolved until this COVID supply chain disruption ends, coupled with all that additional demand for gold.
Yeah, excellent. Ned, you got any additional points on this before we move on to the next topic?
Yeah, I do. And Roy, I love your point there about the central banks. Of course, the Bank of England being the lender of last resort into that system as well. And mainly, I think, as a function of the historic role in vaulting of the central bank reserves. I mean, I take your point that you think that the allocated is fully you can cross exactly the unallocated and the allocated. I mean, it's an unlit faith-based system, and I'm not going to argue with you whether that's the case or not. But I do think it's interesting. I've long suspected that the UK sale of gold reserves was because of this problem. So the Washington Agreement that was signed in 1999, I think it came about because of this choke point, the Bank of England. The Germans asked for their gold back from London. And that was also the time that this quote attributed to Eddie George came out about staring into the abyss. And I think that Roy's exactly right to identify this choke point between the leasing and swapping of central bank reserves. Whether the Bank of England was doing it with other member central banks, I'm not sure, but there was a clause in the original Washington Agreement which probably may have been one of the main reasons for it being signed in the first place, actually, talking about none of that behavior can happen again. So I think that is very interesting, particularly in the context of all the repatriations we've also seen in central bank gold world since. So, this is exactly what I meant by the grey area. There is a very big grey area. Unfortunately, a lot of the fact there's a grey area is because this is the unlit, supportive rail of the entire financial system, the bullion banking system. And it's unlit for a reason, and it leads to some of us having to dig to try and work out and identify what's really going on, and it's unfortunate we have to do that. But look, I think that it's very interesting.
It's a point, Ed, because actually the LBMA is not really a transparent organization, and neither is the Bank of England. All the LBMA has to do, which I've tweeted about before, is rather than use this nonsensical 8,200 ton number, which I think they've sent out 3 emails this month to tell us all that 8,200 tons. Never seen anything like it. 3 emails in 1 month, and videos with the CEO of the LBMA giving us, this assurance. All they have to do is just publish a spreadsheet or a Google spreadsheet that shows how much metal is in each specific vault and who it's owned by, and what denominations. And that would at least tell the market, okay, this is how many are in swaps and leases. These are owed by hedge funds and institutions long term. These are owned by the ETFs, because the ETFs are another important aspect of this. The GLD is allowed to own unallocated. Supposedly it's only 5%, but HSBC being their trustee, and HSBC being essentially the second largest bullion bank behind the curtain other than JP Morgan, it introduces a potential for that unallocated accounting to have a lot of cross accounting, rehypothecation, things like that. Things that are technically all legal, but at the same time, they don't provide the market any transparency. And so if the LBMA and the BOE came out and said, here's a spreadsheet, here's what everyone owns, then we would be able to come up with the figure that was mentioned earlier, which is what is the true float? Because I don't think we really know. We can try to figure it out, but it's just a guess. We don't really know. It's bizarre to me that right now I can't find a counterparty to sell me LBMA unallocated and then ship it to Zurich. I can't find one. So let's just be clear. That's telling you that I can't get the metal from Zurich. The only place where I can get the metal is from London. Shouldn't there be all this metal in Zurich? No one wants to sell it then. But that seems bizarre to me, that we're all relying on this one source of liquidity. The whole world's gold market is relying on this one source of liquidity, the LBMA unallocated pool.
Yeah, I mean, I laugh, but it's scary. It's like one of those laughs that you do when you're nervous. It's telling. It's telling. There's been plenty.
There's another point here as well. Quickly, I know we've got other things to talk about, but just because it triggered in my mind, which is the point about GLD and unallocated. Of course, there was that absolutely extraordinary situation where GLD and Spider did this advert on CNBC a while back, where they took Bob Pisani into the vaults, did like an infomercial for 20 minutes. It was a really long piece, and he sort of made this whole thing about how he was like James Bond, and he'd worn a blindfold and that. Yeah, and then he said that he'd spent a substantial amount of time with the people who keep the bar list, which was really quite dubious, because quite what he thought he would be doing was these people, I'm not sure. But what was particularly odd was he held a bar up to the screen, and you two probably remember the story, but maybe some people listening won't know this. And at the time, people like me were like, well, may as well check the bar list. Check the bar list, and it wasn't on the published bar list of GLD, which was, to say the least, highly amusing. But what was strange about it, my personal sort of element of this, was the next week, ETFS came in to see me in London, because I'm a known kind of advocate of bullion funds rather than ETFs for some reasons I'm sure we'll touch on later. And I told them about the story and said, did you see that situation? And the answer was no, send it over. So I sent it over, and I got an email back going, my goodness, that's our bar. So in other words, he was holding a bar that wasn't on the bar list. Now, like Roy says, maybe it was legal. Seems pretty odd, though, commingling at best or whatever's going on there. There are grey areas, and this lack of transparency is not helpful on any level.
Yeah, you're talking about commingling GLD bars with the different fund bars in the same vault, essentially. And Bob Pisani just being so clueless that he picked up the wrong bar, essentially.
Well, no, I'm saying that he said that he'd spent lots of time with the people who keep the bar list. If that's true, how come they gave him a bar didn't even belong to that ETF.
Well,
The whole thing was
he
very
was
strange.
clearly in the unallocated vault. He wasn't just in an. He was just walking through the unallocated vault where all the metal is commingled.
Yeah, exactly.
Well, that's perfect, because I'll be sure to mix that video in, because I was looking at that video just a month ago, and it's a classic. It's one of those egg on your face reports that happened right as the gold price was peaking in August of 2011, I believe. So thank you for bringing that up, Ned. I want to move on to the topic, I'm kind of ashamed that I even have to do this, and kind of angry that I have to spend time on Easter weekend talking about this, but